Good morning, everyone, and welcome. My name is Adam Livingston, and I am the Bitcoin Wizard. I just got back from the Bitcoin Treasuries Unconference in New York City, and it was an incredible time. Thank you so much to Ed and Tim for putting it on. It was truly amazing to be with like-minded people who truly understand this opportunity in front of us. So I kind of want to regroup my thoughts and condense them all and then spell out the current Bitcoin Treasury thesis and the road ahead. I think a lot of people are still asking, why would I buy a Bitcoin Treasury company instead of Bitcoin? And I'm going to try to answer that question in this video and express how we're still in the middle of the greatest wealth transfer in human history. So right now, Bitcoin is a $2.34 trillion reserve asset trading with the daily liquidity of a mid-tier sovereign bond market. So in the last 12 short months, the network has doubled in market value while its spot volume settled into a steady $30 to $40 billion each day. That scale places Bitcoin on the same footing as the Eurodollar system at infancy, yet this protocol audits itself every 10 minutes with no central counterparty and no weekend downtime. So as you can see, slide 1 is titled here, Bitcoin Treasury Company Thesis 2025 Vision and Blueprint. So what I'm trying to do with this title is signal a new chapter. We are moving from static number go up speculation to an era where Bitcoin becomes programmable base money for the global credit stack. In other words, I believe that the digital gold narrative is going to give way to the digital capital narrative. So my goal is that I want to show how pension funds, insurers, money market managers, and sovereign wealth funds can satisfy their yield mandates by owning Bitcoin-backed credit instruments. And we need to outline the infrastructure that makes that allocation safe, liquid, and scalable. So the framework that you're going to see today bridges the gap between conservative fixed income products and the most secure ledger humanity has ever produced. I think that people who want Bitcoin to go to $1 million need to understand that we need to build the infrastructure. We need to build the pipes to the capital pools that will allow the money to flow to get us there. So here's a quick roadmap that will guide the rest of this presentation. I'm going to examine Bitcoin's current risk-adjusted return profile relative to the Treasury curve, investment-grade corporates, and emerging market sovereigns. I'm going to map the $70+ trillion of institutional capital that is starving for real yields in a negative gamma fiat landscape, and I'm going to describe the instrument architectures, the perpetual preferreds, hash yield notes, option premium bonds that can convert volatile satoshis into predictable coupon payments. So I just talked about pipes. We need to identify the missing plumbing that must be installed for Bitcoin adoption. We got to talk about open source rating models for credit agencies to rate these Bitcoin companies, block level attestation networks, tri-party Bitcoin repo, and a new CFI taxonomy that unlocks index inclusion. So everything you will hear is going to be grounded in hard numbers and live market precedents, including obviously Strategy's preferred instruments and Metaplanet's forthcoming yen-denominated perpetual. These are the two pioneers that are proving that Bitcoin-backed credit is a working reality and it's not a thought experiment. So by the end of this session, you're going to see why Bitcoin should be viewed as pristine reserve collateral for the 21st century, and how a properly engineered credit layer channels trillions of dormant dollars of capital into the soundest monetary operating system ever invented. Let us move forward. So here is the pulse of the network in 2025. The market cap stands at $2.34 trillion, a figure that has doubled in the last 12 months. That growth rate surpasses every asset class outside of artificial intelligence equities and places Bitcoin at roughly 1/5 the size of the US Treasury bill market. Point being, it is no longer credible to treat Bitcoin as an exotic sleeve in a venture portfolio. It now sits shoulder to shoulder with the largest pools of sovereign debt. Currently trading at around $117,000 per coin, we're flirting with all-time highs while absorbing record issuance from miners and sellers without a hiccup. The liquidity is very deep. $35 billion of spot volume changes hands every day on regulated venues, a daily turnover that rivals the Mexican peso and the Norwegian krone in the global FX league tables. And we have seen the volatility of the assets compress pretty dramatically. The 60-day realized figure of 45% is barely half of what it was during the 19,000 to 64,000 run in the pre-ETF era. So that decline in variance, coupled with this persistent upside drift, drives the 3-year Sharpe ratio north of 2. It's placing Bitcoin ahead of the S&P 500, ahead of gold, and in front of every G10 bond index. So now it kind of makes sense why the institutional bid for Bitcoin is suddenly comfortable. This post-2024 policy pivot in Washington has eliminated the custody overhang and has granted fair value accounting under GAAP, letting the unrealized gains flow into earnings instead of languishing as footnotes. And this is all the while CME futures open interest sits at record highs, giving asset managers a mature hedging chassis that aligns with their derivative policies. So if you take all of these facts together, it is revealing an asset that is large, an asset that is liquid, and an asset that is increasingly stable, yet it still offers equity-like returns. Better than equity-like returns, I should say. So all of these things are setting the stage for Bitcoin to become the preferred collateral base for credit instruments that I will explore in the following slides. So let's zoom out from Bitcoin itself and examine the buyers that are currently waiting on the sidelines. First is the OECD pension system, which is $58 to $61 trillion under management. So these plans, they must own long duration, investment grade credit and sovereign debt, yet they are starving for 4 to 6% nominal returns in a world where the 10-year Treasury barely kisses 4. A single percentage point shortfall compounds into multi-billion-dollar funding gaps every fiscal year. Bitcoin-backed notes from Strategy deliver an investment-grade rating while capturing the asset's structural upside that solves this mismatch instantly. Next are the top 300 global pension funds, $24.4 trillion in aggregate assets. Their alternative bucket is capped at 15% and is already oversubscribed with private equity. So these guys need 5 to 7% coupons that settle transparently and require no multi-year lockups. A Bitcoin-secured perpetual preferred sits inside their fixed income sleeve, not their alternatives cap, liberating scarce basis points of risk budget. And then if you move down the list to insurance balance sheets, in the United States alone, $9 trillion chase securitized credit, subject to punitive capital charges that drag net yields into the low 3s. Bitcoin-backed credit destroys that yield. And then finally, the liquidity hawks, the money market funds, $6+ trillion in the US in ultra-short paper, forced by statute to hold securities a weighted average maturity under 397 days and a AA handle. So this is the pool of capital that Strategy's Stretch is obviously trying to target, ultra short duration credit. And what's amazing to see here is that only in this money market fund bucket, the $6 trillion sitting in these funds, that's almost 3 times what the entire Bitcoin network is worth today. So as you can see, guys, the capital is ready. It only lacks the instruments and the regulatory plumbing that we need to outline in the rest of the deck. So now let us define the linchpin of the entire thesis, the Bitcoin Treasury Company. A BTC-TC is any public or private corporation whose balance sheet is built first and foremost on Bitcoin. It raises capital whether via equity, debt, or hybrid instruments using that Bitcoin as direct collateral. So think of it as a modern central bank without the bureaucracy. The coins are sitting on chain, verifiable by anyone, and every security that it issues is traceably linked to that Bitcoin collateral base. And these are the 3 core attributes that make this structure revolutionary. And first is the positive capital polarization. Bitcoin's compound annual growth rate has exceeded 30% for over a decade, while the average cost of capital in global markets hovers in the single digits. So that spread between the average cost of capital and the long-term Bitcoin CAGR means that any time a Bitcoin treasury company sells a new security, be it a preferred share or one day a bond, the net asset value per common share actually rises. Traditional issuers usually dilute, but in Bitcoin terms, this polarizes upward. And second, there is an economic defense layer. And we know this because Bitcoin miners defend the protocol with hash power, but Bitcoin treasury companies defend the macro narrative by translating digital capital into instruments that these pensions, these insurance companies, and money market managers can own without amending amending their charters. So right now, the entire game is to turn Bitcoin from an outside bet into a compliant yield-generating allocation. And the third attribute is digital refinement. So picture the company Standard Oil in the early 20th century. Everybody remembers that they refined crude oil into gasoline, kerosene, and plastics that have fueled entire industries. In the same way, Bitcoin treasury companies refine raw satoshis into their yield notes, liquidity tranches, and leverage products demanded by these legacy finance capital pools. A lot of people think they just buy Bitcoin and sit on Bitcoin. No, they are manufacturing financial energy products from digital crude oil. So with these three pillars here, capital polarization, economic defense, and digital refinement, Bitcoin treasury companies become the corporate engines that are pulling trillions of institutional dollars onto the blockchain rails. And this is the structural shift that we are here to architect. This is Bitcoin adoption playing out in real time. So this slide is the engineering blueprint, the instrument design framework that turns raw Bitcoin into yield-ready credit. So first, we got to talk about the credit geometry. The first is the collateral ratio. If we target yield-hungry hedge funds, a 2-to-1 ratio might be enough. For investment-grade buyers, we tighten 10-to-1, and for AAA money market funds, we can stretch north of 20-to-1. One framework, but three distinct risk buckets. We need to take our Bitcoin capital base and then design products around it that will allow more allocation to the asset itself. Another important aspect is duration, because not every investor wants to buy Bitcoin because Bitcoin is an infinite duration asset. If you have Bitcoin on your balance sheet, you can mint anything from a 30-day commercial paper note to a perpetual preferred share. Duration is the dial that you can twist to match each buyer's liability profile. There's also the currency wrapper. Obviously, we have these treasury companies popping up all over the globe. Tranches can settle in dollars, yen, euros, Swiss francs, fully hedged on balance sheets, so the end holder never feels FX drift. And then another very important part of the credit geometry is the volatility stripping. Collars, protective puts, or total return swaps peel away Bitcoin's price swings that turn people away from the asset itself. So your coupon stream can remain smooth while the Bitcoin treasury company retains the upside convexity of Bitcoin. And so now the key benefit is that investors can receive a stable, predictable coupon that slots neatly into whatever mandate there is. Meanwhile, the Bitcoin treasury company still harvests the convex growth of that underlying assets that creates a win-win structure for everybody. Conservative capital pools achieve yields without exotic risk, and the Bitcoin treasury company amplifies net asset value through positive capital polarization. And this is how we are going to transform digital capital into compliant, high-demand credit. One geometry, infinite product permutations. And we're all going to use AI to design them over and over again. And then prompting AI over and over again to improve those products. So to ground the framework and this kind of macro thesis in reality, here are 4 live-fire examples of product structures, each tailored to a direct institutional mandate. Number 1 is the perpetual preferred, the US dollar tranche. Strategy does this. And the target buyers are obviously US pension funds and sovereign wealth funds. They're kind of making one for all kinds of buyer segments, to tell you the truth. Coupons are printing north of 8%, as high as 12.3% if you like Stride. Strategy's debt is currently sitting at about 11% of their balance sheet, so it is totally over-collateralized. And some of these are hypotheticals. I kind of gave MetaPlanet's incoming perpetual preferred the Meta Yield Note name. But this is what they can do. They can design an instrument for the Japanese money market funds and insurers desperate for real yield in a zero-rate environment. Remember, all the institutions are used to a sub-1% JGB, so this is a generational upgrade without leaving their domestic currency silo. And a lot of treasuries, they need overnight liquidity with pristine credit, so here they get SOFR plus 30 basis points. Over-collateralized 20x times in Bitcoin and structured to comply with 2A7 money market regulations. So in practice, these would behave like treasury bills, but the spread is juicier and the collateral appreciates instead of inflating away. And then with hedge funds chasing that convexity, we could offer a 12% coupon with 1.5 times Bitcoin backing and detachable warrants on the upside. You could have that sit below the capital stack, trade like a distressed credit with Bitcoin's rocket fuel embedded, and it will pay managers for carrying the volatility that others fear. So together, these are kind of the 4 archetypes in my mind that prove Bitcoin collateral can be engineered across the entire risk spectrum, from AAA cash management to speculative upside plays while staying within the guardrails of the traditional mandate language from the legacy system. So, one asset, Bitcoin, 1,000 products, and that means trillions of dollars unlocked to flow into Bitcoin. So after I've shown you the blueprint and have showcased these potential products and some that are already existing today, I want to talk about the 3 most critical infrastructure gaps that are still standing between us and the $1 trillion Bitcoin credit market. In other words, what's standing between us and $1 million Bitcoin. So let's address them one by one. Number 1 is the rating and risk framework. Not a single legacy agency, S&P, Moody's, Fitch, has published a formal methodology for Bitcoin-backed instruments. So that silence right now is forcing every new deal into bespoke private label territory, choking the scaling. So what we need is an open source Bitcoin cash flow coverage model coupled with real-time on-chain attestation, a network that will feed auditors and ratings desks every single block. So until that framework exists, the risk premium is going to remain artificially high. Gap number 2 is the instrument recognition. All of the deals that have come together so far to fruition, to the marketplace, are literally just a rounding error for global fixed income. Some of the ones that will be eventually coming out might live in regulatory gray space, lacking a standardized CFI code, a universal term sheet template, no clear guidance on how the coupons sourced from Bitcoin cash flows should be classified. So without that taxonomy, the index providers won't include the securities and passive capital cannot follow. So standardization is non-negotiable. Another pipe to construct. And that brings us to the overall market plumbing. Today, Bitcoin collateral is ineligible for tri-party repo, which means primary dealers cannot recycle balance sheet efficiently. We need trustee-led facilities that accept BTC at predefined haircuts, a DTC to on-chain bridge for atomic settlement. We need the machinery of global liquidity to operate at Bitcoin speed. So if we solve these 3 bottlenecks, ratings, recognition, and repo, the capital dam breaks. So the pipes are half built. It is up to us to finish the job and let the flow begin. And this is the job of Bitcoin treasury companies. I hope that you're starting to understand the value proposition. Michael Saylor himself said that this is going to take a 4-year period of time to uncramp the banking system. There's just a sequence of dominoes that must fall to unleash the multi-trillion-dollar Bitcoin credit market. And it's going to take time. Somebody is going to have to publish a Bitcoin cash flow coverage model under Creative Commons, gifting ratings agencies a turnkey methodology for doing this kind of thing. Am I going to be the one to do it? Should I just do it and pitch it nonstop? Somebody has to. It might as well be me. And then we just need to market it. We need to talk to people, because the moments that Standard & Poor's can copy paste a spreadsheet starting from scratch, the conversation shifts from should we rate this to what notch above investment grade does it deserve? And I'm not going to go over all these into detail, but we do need classification. We need QSIP taxonomy being ratified. We want these perpetual preferreds to be index eligible. Once Bloomberg and FTSE Russell add Bitcoin cash flow bonds to the global aggregate, passive mandates are then going to flow automatically, writing checks measured in basis points of trillions. And I'm not hoping it really takes till 2030, but if we saw major sovereign wealth funds adopt 3% allocation to Bitcoin, that would be the instance the asset class graduates from innovative to inevitable. The real flood of capital would then begin. I don't think it'll take 5 years. I really don't. I think with the strategic Bitcoin reserve, with the rumors of incoming legislation still kind of on the way, well, it's going to be exciting. If we start hitting these targets, these are going to be the crumbling walls that Bitcoin needs to scale in order to reach $1 million status. So right now, Bitcoin is pristine collateral. Obviously, everybody knows that by now. At least everybody in the know knows that now. But this is going to be the beating heart of the new global credit system, and very few people are aware of this. I feel that out of the population, maybe 20% 1% of it know what Bitcoin is vaguely. 0.1% of those people truly understand Bitcoin, and I feel like 0.1% of that populace understands the value proposition behind Bitcoin treasury companies. If you are watching this, you are part of the 0.1% of the 0.1% as far as I'm concerned. So we close with a grand vision, a century of digital capital. Remember this, just imagine the early petroleum era. Once crude oil was refined into diesel, jet fuel, and plastics, the value of those derivatives dwarfed the raw feedstock, and Bitcoin is poised for the same metamorphosis. So if you picture a world where Bitcoin collateral swells to $100 to $200 trillion, on top of that base layer, an equal magnitude of Bitcoin-denominated credit and equity will circulate. Notes, bonds, preferreds, ETFs, all settling at light speed on open ledgers. So every saver on Earth, from a teacher's pension in Ontario to a shopkeeper in Vietnam, they all can access censorship-resistant, inflation-shielded yield with a phone and an internet connection. Settlement risk evaporates, reconciliation becomes a relic, and liquidity operates 24/7. And the flywheel is self-reinforcing, which is the fun part. Each new credit tranche will just buy more Bitcoin, driving the price higher, which deepens the collateral coverage, which lowers the perceived risk, which unlocks even larger mandates that are already out there. Round and round the wheel spins, compounding adoption over decades. So this is not merely an upgrade to the bond market that exists currently. It is the birth of a global permissionless capital engine powered by mathematics, accessible to all, and limited only by our collective imagination. So it's time to build the future of finance together. I'm going to finish with a direct call to action for everybody in the Bitcoin treasury space. It is time to build the infrastructure for a $1 trillion Bitcoin credit market. It falls to the visionary operators in the room to seize the moment. Here's your quick 5-step playbook, okay? You gotta design a Bitcoin-backed preferred share or a note that plugs a genuine mandate gap into your target market. And do not chase novelty for its own sake. You need to solve a pain point in your populace. If a pension needs 6% duration, give them 6% duration backed by digital gold. In step 2, you obviously have to take partners. Align with a top-tier custodian and an independent trustee. Their sole job is to attest collateral every block and keep the regulators comfortable. A paper yield is worthless if compliance officers cannot sign off. Get these boxes checked. And eventually, I think that some of these securities are going to be tokenized. Maybe we don't get into that too much in this video, but I'm just saying, if you marry the speed of crypto rails with the gravitas of QSIP land, well, things can get exciting. That's a bit more into the future, I know, but still, imagine that. And step 4, we need to educate. We need to train CFOs, pension consultants, and ratings analysts on positive capital, polarization, and Bitcoin's superior risk-adjusted returns. It can't be only me, folks. I need some help here, okay? We need to arm them with data, not dogma, and their objections will melt away. Larry Fink did it, okay? The rest of you can too. And step 5, we need to iterate. We need to continuously improve the product architecture, collateral ratios, coupon mechanics, hedging overlays, until we out-innovate the institutional inertia and capture market share before the competitors even draft a term sheet. And we need to leverage AI to do this. If you have a problem to solve, you need to leverage AI. Be humble enough to ask for help, because the next 1 trillion barrels of digital energy are waiting out there, waiting to be refined. So now let us build the pipes and ignite the flow right now. Thank you so much for watching. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed this content, please like this video, subscribe to the channel, and help me spread the orange gospel to the masses. Have a terrific day. Class dismissed.